When can you retire? What are bonds? Have you ever wondered about market fundamentals and the importance thereof? How about in-service rollovers? Income laddered approach. Folks, this is all things we're going to be talking about today, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Have you ever wondered when you can retire? Listen, this is a question we get asked a lot. Folks will come into our office, they'll say, listen, this is what I have, can I retire? Folks, there's a lot of different things that have to be considered. The first thing that we have to ask is how much income a person wants. You know, what's the lifestyle they want to enjoy when they're in retirement? We've got to start with that because I got to have a picture of how much money that's going to be and what that looks like. The second place I want to go is I want to look for sources of income. You know, do I have pension income? Do I have rentals? Do I want to still work part-time? Do I have sufficient savings? I want to, Social Security, what's that going to look like? So I want to look for sources of income. Another thing I want to look at is debt. Am I going into retirement with any mortgage debt or any other kind of debt that might, you know, hurt my cash flow when I get into retirement? So we're going to have to look at that. And then again, savings. You know, how much did I put away in those IRAs, those 401ks, those 403bs, those 457s? You know, how much do I have there that I can count on? And then there's another factor we want to look at is health insurance. All right, if I'm not at the age of 65 and can receive Medicare, how am I going to bridge that gap if I'm stopping working and having health insurance? You know, where is that going to come from? So we want to look at that. Inflation. You know, I might have all the means to pull together a plan today, but with inflation, is it going to be able to keep up with it over time? If I live another 20, 30 years, the purchasing power I have today is going to look much different down the road, and maybe I want to be, you know, having that, you know, put into my plan as well. Income taxes, you know, if I've got all my money in IRAs and now that's the only place I can pull income from and every bit of it is going to be taxed, well, what does that look like, right? Or maybe I'm somebody that's fortunate enough to have other buckets of money, let's say non-qualified money or what's really called non-retirement money. Or how much do I have in Roth IRAs where I can pull and not have it be taxable? And what's my tax plan as I begin to take that income? And if it's all going to be taxable, well, isn't that going to affect things as well? Can you see that there's so many factors involved in making that decision as to whether you can retire? And so I can't stress enough, having an income plan is so vitally, vitally important. You know, you should be looking at this 4 or 5 years before you pull the trigger, just so you know what it looks like. Or if it has some deficiencies, you have ways to correct it as you approach that date. So if that's you, as you're approaching retirement, you're maybe 4 or 5 years out and you're wondering whether you can pull the trigger, then I encourage you, give us a call and we can sit down and develop some kind of a plan for you before you decide to do it.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and to educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
Welcome back. In this segment, I want to talk to you about bonds, or what we call fixed income instruments or financial instruments. Listen, there's all kinds of bonds. There's what they call government bonds. Government bonds are simply bonds that are backed by some kind of governmental unit, whether that be a municipality, a state, federal government. Okay. Now, bonds can also be corporate, or what you call private. These are bonds held by that corporations issue. Okay. Bonds, for the most part, are debt instruments. Okay. They're backed by the full faith credit of the person that issued the bonds. So if you're getting a corporate bond, it's simply backed by that corporation. Now, most generally in the financial world, bonds are considered safer than stocks. And here's why. Because it's a debt instrument, it actually in a case that company was going bad or went in default, bonds get paid before shareholders get paid or stocks get paid. So, and in case of a governmental unit, they can tax the people to pay that bond. So for all practical purposes, for the most part, bonds are usually considered a lot safer than stocks because they get paid off first in the event anything goes wrong. So credit qualityness is going to be a very important factor. It used to be said that, municipality bonds were, were all safe. Because they could be backed up by the municipality. But now we're seeing municipalities file bankruptcies. So, are they all that safe necessarily? So credit qualityness is going to be a huge, huge factor, especially when it comes to corporate bonds. How solvent is that company? How good is its ability to be able to pay that bond back? Well, that can be measured. We can do that through an analysis to see, how those rate. You have to understand too, bonds are interest rate sensitive. When rates are rising, bond values can go down. You say, well, how does that work? Well, let's just say I'm holding a bond today that's paying, let's say 3%. But tomorrow, because the interest rates rose, interest rates went up to 4%. Now I can get a bond paying 4%. Who wants my bond paying 3%? So they're going to adjust the value of that bond accordingly for all the lost interest that I'm not going to be able to get with that bond. So as interest rates rise, bond values can go down. Now, the taxability of bonds is a huge thing as well. If you're in a federally government-backed bond, it's usually going to be state tax exempt. If you're in a municipal bond, state bond, it could both be federal and state exempt in some cases. So there's a lot that happens with bonds. I hope this was valuable. But if anything, if you've got a strong bond portfolio and you want to just see how it stacks up as far as credit quality and this and that, then certainly give us a call.
Larry, that's really interesting that you bring up the topic of bonds. I was literally just having a conversation with a client last week, and we were evaluating different options. He's looking for maybe some shorter term options versus what he's holding currently in his savings, but he was trying to utilize municipal bonds to take advantage of some of the state and federal tax free aspects of that. And so when I started running the numbers, I basically came back and found those rates aren't all that attractive because of the premium that he would have to pay in order to get those shorter term bonds. It ultimately put him in a spot where he was probably better off just holding that money right there in his higher interest savings account. So it's really interesting when you're evaluating all those different options to pay attention to the rates and not just go with initially what you think might be the best solution. And that comes back, Art, to when we're talking about planning to retire well and all those different areas that come into play.
Absolutely. And Larry, that first topic you talked about, when can I retire, and lots of different ways to ask that question. But I think it's interesting that when you talk through all the different things that you have to think about, folks, many of you probably start thinking about that question right after you start working in your 20s or 30s. When can I retire? But yet so often we see people, right at the end there, they kind of fail to ask themselves some of those questions and maybe even work longer than they need to because they're not sure of those answers, or maybe they retire a little too soon and didn't ask the right questions themselves. But the key to that, like John said, we want to help you plan to retire well. That includes making sure you have an income plan, tax plan, estate plan, legacy plan, insurance, all of these different pieces that come into play here. And if nobody's asking those questions, are you? So it's really important to kind of think through those and make sure you have a set plan so that you can retire and know that with confidence so you don't have to worry about that. You can go and do those things that you want to do, whether that's play with grandkids, travel, play golf, hunt, fish, all these things that you've been wanting to do, you just haven't had the time since you've been working your whole life, right?
Yeah, Art, I'm glad you brought that up about the planning, because I tried to share with the folks, you want to get with us about 4 or 5 years before you pull that trigger. I mean, if there's any deficiencies in the plan at all, at least then we've got 4 or 5 years to kind of work it out and make it better. So anyway, and I'm glad you're staying tuned, but in the next segment, I'm going to talk about market fundamentals and why it's so important to pay attention to them. So stay tuned.
Welcome everyone. We here at Centennial Wealth Advisory are proud to be champion supporters of Bethany Christian Services, helping so many families across northern Michigan.
And supporting this fun event here with Swing Shift in the Stars.
Every night around the table after grace, we all hold hands, and the child of the day that has done something kind gets to go and say family, and then we all follow through and say always and forever, no matter what, and then we squeeze hands.
What qualifies someone to be a foster parent is simply if they can love a child.
What Bethany Christian Services is to Michelle and I is a lot of different things. Kids don't come with a rule book, and foster parenting definitely doesn't come with a rule book, even though there's licensing and stuff that goes along with it. But what they are to us is a resource. And no matter what questions we have, it's an easy phone call to make, it's an easy email to make, and within minutes, if not the very next day, they're back in touch with us with an answer, a solution, or a helpful hint to try different things.
Hope keeps us going, but love is the reason.
Bethany Christian Services is a global nonprofit that supports children and families with world-class social services, all designed to help families thrive.
They love children. They love God. They know that they want to spread that love throughout the world and help those vulnerable children.
Love is not always easy in some situations, but you kind of let your barriers down. You let your guards down. When you see children in this tough situations they're in, you kind of throw caution to the wind and don't think about the consequences. You don't think about the what ifs, and you just say, if I have a few days to fall with these children, maybe I can change their lives.
Fostering has taught us to be flexible, to have more faith, and let go and let God.
I want to help you. I want to give you some love. Come here, I want to give you a hug if that's okay. That's what qualifies someone to be a foster parent. You don't need to have all the answers, because nobody does. You don't need to have all the training down pat, because you can't. You learn as you go. But if you're willing and you have that love, that's what makes a good foster parent.
If you see a 2-year-old kid come into your home, it's never had love, it will change your life forever.
It means that if you're sitting at our table, I don't care if you are a foster child, if you are a biological child, if you're adopted, if you're off the street, your family, always and forever in our house.
Hi, welcome back. Now listen, in this segment, I want to talk about market fundamentals. There's a lot to listen to out there when you're listening to the news, and everybody has their own opinion, don't they? But for the most part, you have to understand markets are pretty predictable. They'll, for the most part, will trade at a multiple of its earnings. Now, I know there's volatility. There's times when, and we've seen it in recent months, where it dropped 3% in one day. That's not what I'm necessarily talking about. I'm just saying, as a general rule, markets will trade based on the underlying earnings of the corporations. And as a general rule, historically, it's traded around 16, 17 times earnings. That means if it's much higher than that, we're most likely in overvaluation territory. And it's done that historically in the past. So, you know, if it's just done it for quite a long time, that's something we're going to want to maybe be concerned about. If it's trading below that or well below it, some might argue that's maybe bargain territory, right? Good time to buy in. But for the most part, it's going to track pretty closely with earnings, or a multiple of those earnings. So that's one fundamental we're going to want to pay great attention to if we're in overvaluation territory or we're in bargain territory, or if it's trading right within those fundamentals. Yeah, because if it's trading right within those fundamentals, and historically not above or below, and we're hearing a lot of bad news, is it something that we necessarily need to react to right away? It could be just a lot of emotions going on due to that bad news. Okay, so if you're a long-term investor, sticking to the fundamentals and understanding where the market's trading regarding maybe those earnings is going to be very important. Another thing to understand is when you're looking at fundamentals, you want to look at all the things that drive consumer spending, or what we call small business spending as well, because 87% of our GDP is basically small business consumer spending. So how those people are feeling about the economy, whether they're spending or not, is going to drive those earnings, which, as I just previously indicated, is then also going to drive the market. So we want to look at everything that's going to affect those earnings. For example, if we have low unemployment, why is that good? Well, it means if more people are working, they have more money in their pockets, and if they're feeling confident about the economy, they're going to spend that money, which is good for corporate earnings, again, which is good for the market. So confidence levels, how people are feeling, is something that we want to pay attention to. There's a lot that goes into market fundamentals, a lot of things we want to look at, but all the more reason you want to be talking to an advisor who's paying more attention to those kind of things. At Centennial Wealth, we do. So I encourage you, if you're at somebody and you just want to kind of see where you're at and how you're positioned relative to the market, then give us a call.
Hi, my name is Jack Clunner, and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
Hi, welcome back. Listen, in this segment, I want to talk to you about what's called in-service rollovers. If you're in a 401k plan, maybe a 403b plan at your job or your work, what you're going to want to know is it possible for me to roll that money over from my 401k, 403b into an IRA, or even my own existing IRA if I have one? Knowing this is very important. Now, many people believe that they have to wait till they're done working before they can do that. But you'll be pleased to know that a lot of plans will let you do it before you're done working. Some will say, well, you can do it at any time, which would be desirable. Some say you might have to wait to a certain age, let's say 59 and a half. And again, like I said, some might make you wait till you're done. But knowing whether you can do it or not is going to be very important. Why? Well, as you're aware, when you're in a 401k, 403b plan, your investment options are going to be limited. The plan administrators do this because they don't want you to have 1,000 different choices. That makes their administration much, much harder. So they're going to limit how many choices you have. But what if I'm somebody who wants more choice? Maybe I don't like the choices they've given me. Then I'm going to want to maybe get it over into an IRA where the whole world is available to me. Because anything an IRA can be invested in is going to be open to me. My choices become greater in that environment. So it's going to be important for you to call your plan administrator, find out. The question you might want to ask them is, say, listen, I have an IRA. When am I allowed to take my money from my 403b, 401k and roll it over into the IRA? And they're going to tell you when you can do that. So knowing that is going to be very important. Now, a lot of people will ask this question. Larry, if I do that, do that rollover, is that going to create a taxable event? I can assure you that that is not a taxable event. When it's a rollover, it's going from one custodian to the other custodian. You're never receiving the money. So in that kind of event, there's no tax consequences. As a matter of fact, there's not even any reporting that has to happen because you never took custody of it. So again, check with your plan administrator, see what they allow, and then if you're somebody that can do it or wants to do it, then give us a call, because then we can show you those investment options that you might not have right now that are available in an IRA. I mean, you can have an IRA invested in gold. You can have an IRA invested in silver. It can be invested in real estate. There's a number of things that it can invest in, may be more appropriate for you under the circumstances. So give us a call.
Larry, that was a really good segment about, the in-service rollovers. I think oftentimes people think that they're just kind of trapped in these plans that they've been saving for 30, 40 years and limited by the options. Now, maybe you're real happy with yours, but I think it's important to know that there are options out there, especially for those of you that are 59 and a half and still working. There may be a chance that you can do one of these in-service rollovers. And you ask yourself, why should I consider that? Well, Larry talked a lot about that in the segment that we're just coming off of here. But remember when we talked a lot about planning and when can you retire? That's a really key piece. And when we're working through all these plans, what if there needs to be some adjustments done prior to your retirement? Wouldn't you like to do that when you were still working versus maybe learn that too late? What if there's some tax things that could be taken advantage of or adjusted while you're still working? Wouldn't that be nice to know maybe a few years before you're retired? 59 and a half, even if you were going to retire early at 62, that still gives you 2.5 years to adjust things and maybe tweak things slightly to make it so you can retire well.
Yeah, and I think, guys, it's so often where people come in and they've got their statement and they say, well, nope, I've got this money saved, and we then ask them, okay, well, what's sort of your plan? And ultimately, there isn't a whole lot of planning that's been done other than saving, which is fantastic to save that money. But what about those areas of, okay, let's map out how long is this income going to last for you, and what are the tax consequences of drawing that income from the portfolio? Hey, what about an estate plan? Have you looked at that? Or insurance, I mean, is huge now in your retirement planning and a key factor that needs to be considered. So there's a lot of different areas that we find that need to be reviewed prior to making that big decision of retirement. So that's where we always encourage you. Just give us a call, and we're happy to sit down with you and talk about how we want to help you plan to retire well.
Yeah, our whole show, isn't it, is how to teach people how to plan to retire well. Key term there is plan. Plan, plan, plan. And there's so many different things to plan for. Like you said, John, don't just pick one aspect and think, okay, I'm good. I talked about in the early segment about debt. Do I want to be going into retirement with having any kind of debt? Well, if I don't, I better be planning ahead of time to make sure that's paid off. So anyway, stay tuned, because in the next segment, I'm going to be talking about taking income and what's called the laddered approach. And I'll explain more in Chalk Talk. So stay tuned.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and to educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
Hi, welcome back. Listen, in this segment of Chalk Talk, I want to talk to you about what we call the laddered strategy, okay? This is a way in which you can structure a portfolio to get the maximum results, especially if you're taking income in retirement. All right. First of all, what you want to do is segment a certain amount of money aside for just the first 5 years. Okay, so let's say I'm wanting to take 5% from a portfolio. Let's just use that as a general rule. That's going to be basically 25% of my portfolio. Okay, so I segment that aside. Now, because that's short-term in nature, because I need it in the first 5 years, how that's going to be invested is going to be highly conservative and very liquid, right? I might, in this environment, I might only get 1%. on my money there, right? The second thing I want to do is then set enough aside for what we call the next 5 years after that, or the 6 to 10 years, okay? Now again, if I'm taking 5%, that's going to be another 25% of the portfolio. Now, because I don't need this in the first 5 years, I've got 5 years in which it can grow and then take income. How that's going to be invested is probably going to be, still conservative, but a little bit more different than what I had in the first 5 years, okay? In this environment, maybe I'm only getting 2 to 3%, okay, on my money. Now, if I've structured it this way, I've got half my portfolio, right? 25% in this bucket, 25% in this bucket, and so I've got half my portfolio very conservatively invested for my income in the next 10 years. Now, everything else can go into that 10-year plus bucket, okay? Now, because I don't need that for 10 years, I can have it probably in a traditional growth bucket, which means it's probably taking on a little bit more volatility, but because I have time, I'm going to get a little bit more growth out of it, right? Now, for this example, I said, let's just use 7%. Let's say it's in that bucket, I'm getting 7%. Using the rule of 72, which is if I take 72, divide by any rate of return, it's going to tell me how often my money doubles. So if I take 72, divide by 7, it means my money is going to basically double in about 10 years. So if I use this money for the first 5 years, it runs out. And then from 6 to 10 years, I use the rest of that money. Okay, so then it runs out. And the rest of it's in this bucket, growing by 7%. I already know that it's going to pretty much double in that 10-year period. All right? Then all I have to do is turn around and take that money, take 25% of it, put it back here for the next 5 years, then another 25% here, and again, doing that every 10 years. Can you see how this could maybe make your outcome a little bit better, especially when you're taking income? I encourage you, if this is something you want to take a closer look at, then give us a call. We'd be glad to go over this with you.
That was great, Larry, because I really like the visual. I'm a visual learner, and doing the income laddering approach and everything provides you a good visual to sort of say, okay, how would that potentially work for your plan? And obviously we're talking about different time frames, different interest rates, so there's a lot of different variables, but it does give you the ability to see how long is this money going to last, and depending on how much income you want to draw from your portfolio. So there's again a lot of different factors that come into this overall, but it is a good way to provide a visual, right, Art?
Absolutely. You're even going back to our last time that we were talked here with the in-service rollovers. You have this 401k statement that has this number on it. Your balance. That number has to provide over the next 30, 40 years. We don't know, right? That's the $1 million question. We don't know how long you're going to live. And when, like Larry does here on the Chuck Talk, starts chopping that up into segments, it starts to become a little easier to digest kind of how this is going to work out over the rest of my life. You've been saving and working for 30, 40 years. Now it's time to make that number generate a paycheck. And how are you going to do that? This laddered approach here, likely you're not going to need all your money day one in retirement, but we also probably don't need it all on the 40th year day. So there's going to be times that we're going to need that. We want to have consistency over time. Most people that we know don't want to rely on the market performance to drive what their income is going to be in retirement, right? So thank you for watching us this week. Hopefully you've learned a few things on planning to retire well. If you remember anything at all, the importance is planning. We'd love to sit down and talk to you more about that and how we may be able to help you. If you've never had somebody walk through this process with you, now is the time. Come in for a free, no obligations, no pressure approach from us. We're happy to sit down and see what we can do. Catch us again next week here on Retiring Well.